Teaminvest is an exclusive investment community with over 600 members across Australia and New Zealand. We use our proprietary software and the wisdom of the crowd to analyse companies like business owners, not speculators, to identify wealth winners and avoid capital killers. Our members expect an annual return of a minimum of 15 to 20%, with many of them achieving much more over the 18 years we have been running. At Teaminvest, we're about transferring our knowledge to the next generation of investors. Whether you have been raised with an awareness of investing or whether the family legacy begins with you, our goal is to educate and equip you with the knowledge and tools to build generational wealth.
Welcome to our special three-part Emerging Wealth Winners series. In October, we hosted the Emerging Wealth Winners Conference in Melbourne, where we invited 7 businesses that combine resilient business models, disciplined capital allocation, and long runways for growth. In this series, we're shining a light on those 7 ASIC listed businesses that are on their way to earning the coveted Wealth Winner tag. In this first episode, we're looking at Solvar Group, a small cap lender focused on secured automotive finance for underserved Australians with non-prime credit histories. To unpack how they've done it and what comes next, we'll hear from Solvar Managing Director Scott Baldwin in conversation with Ausbiz's Kylie Merritt at the Emerging Wealth Winners Conference.
Small cap focused on secured automotive finance for underserved Australians with non-prime credit histories. Despite some regulatory challenges, a stoush with ASIC, the group has maintained strong unit economics and consistent cash generation. Tip Group calls it scalable and resilient. I asked MD Scott Baldwin what metrics would demonstrate that description.
In terms of scalability, I mean, the finance market for assets in Australia, new and used, consumer and commercial, is around $55 billion a year that's funded. So if you look at last year's results, the Solvar Group funded around $390 million. We are a rather small participant in a large market. So there is a lot of opportunity to grow. Our products don't address all of that $55 billion, but we certainly have a large target market within that sector. The resilience, I think, comes from the fact that 2 things. We've been trading for over 25 years now in this sector, focused on providing finance to people that don't fit the bank's strict criteria, and I think we've been successful at that. We've demonstrated we can do it year in, year out. And in terms of that, I think what has helped drive good strategic decisions, 1 in 5 shares in the group today is owned by staff or past and present directors. And I think that helps us make decisions. It certainly aligns everyone, whether it be new investors or the board and the staff, in terms of our decision making, because we're all rewarded principally by the same thing, by improving the equity that drives the business.
So will that scale come from continually eating into that very big target market that you have, or will it come from acquisition, or will it be a mix of both?
Look, I think that's a great question. I mean, it needs to come from both. I mean, we launched a brand in the last 12 months called Benji, which is a dedicated team with dedicated commercial experience driving a product through our distribution network that we already have for small business. And that team is focused on small business alone and giving them access to finance for assets, and that will drive growth. Already in October, we've done 50% of the volume of what we did in the last 5 months. So it's a startup that's starting to grow. It's not quite ready to move to scale yet, but that will drive growth in our business, in terms of providing products through our distribution network.
Oh, so is that Benji business that's not just automotive?
That's just the Benji commercial business. The distribution channel has been built over many years for all of our products, Money3 and automotive financial services. So Benji is leveraging that. The new staff that we've hired in are ones that have got deep commercial experience, so that way we're offering the right product to our distribution partners.
Solvar hasn't always been solely focused on the automotive industry, but now it is. It's been quite a big sort of strategy shift for you. How's that changed your risk profile and also profitability?
Yeah, the Solvar Group has been around for over 25 years. but we made a strategic decision to reposition our business, and we sold the branch network that was part of the group in 2018. And that sale brought funds into the business that allowed us to organically grow our core brand, Money3, but it also allowed us to expand through acquisition. So we bought a business called Go Car Finance, we bought a business called Automotive Financial Services, and we also bought Holden Financial Services when General Motors exited Australia. So we have demonstrated, I think, over time, a good mix of both organic growth and strategic acquisition. I'd like to say we've got most of them right. Certainly we've made some mistakes in terms of our growth, but if you look at the journey of our organisation, we've paid dividends every year and distributed almost $1.40 in fully franked dividends since listing the business. So a mixture of both, I guess, is the answer, organic and...
So you target an underserved segment with, low or non-prime credit history. What's your bad loan book look like? And how importantly, or more importantly, how do you manage it while still serving that market?
I think at the core, most Australians feel good when they pay off their loan. They intend to and want to pay off their loan. So a lot of managing customers through that cycle, if there are challenges, because we find that vehicles break down, marriages break down, and jobs get lost. And we have a large dedicated internal team that are very experienced in managing those problems with consumers and managing changing payment profiles in order to align with when they can afford to pay. And that's what keeps our bad debt lower. And if you look at take the last 5 years history, our bad debt profile has stayed within 3.5 to 4.5%. And it's that consistency of band that makes it easy for banks to fund the organisation, because it's the certainty that people are looking for. It's not necessarily a percentage, but it's the consistency within our group. So we build our model around sort of that level of bad debt expectation, and we've done that for a number of years.
And these are relatively small size loans.
The typical loan through the Money3 business, for example, is about $11,000-12,000. They are not, they're not home loans. They're not large commitments to people. And when things go wrong, if people can make a $50 to $80 a week commitment, they can generally pay off their loan over a couple of years.
So speaking of that market segment, you had a win not long ago with ASIC over lending practices that were from quite a few years ago. Where are you now with proceedings with the Commerce Commission in New Zealand? And also, what are the learnings from these cases? How do you ensure investors that you've actually come out the other end stronger?
Yeah, if I can work backwards there, I mean, since ASIC raised their concerns with our business, I mean, we invested heavily in training. We've made changes to our credit risk appetite. We've made lots of changes to our product. We don't want to be in this position with the regulator. We'd like to have more dialogue with the regulator so that when they have concerns that they bring them to us rather than go straight to litigation. It's been costly for both parties. But what have we done? We've changed our products. We've listened and looked at what ASIC was seeking through this process. We've tried to train our people better. We've invested heavily, particularly in things like First Nations training, First Nations awareness across our organisation. We've looked at our policies, our procedures, and particularly our lending, and we've adjusted considerably from where we were in 2000 and sort of 15 to 18. Because these issues were for over 5 years ago that ASIC raised. So that compliance and governance framework that sits around the business is far more robust today than it was many years ago, and hopefully that has been the right tack for the business. Has cost the business. There's no doubt that investors would look and see that it has had an impact on profitability, but it should make us more industrial grade to continue to be here and participate in that lending segment.
All right, we all know that there's an AI for everything. We have heard a lot about financial institutions using AI, to look at things like credit risk. What are you doing in this space to help the business?
We are using AI. In fact, at the moment, all of our executives are doing a Northwest Kellogg AI executive training course to improve our understanding of how it can be utilised in our business. What we want to do is try and have focused use of AI rather than just continue to dabble. Our business has introduced AI, is part of the reason why investors will see that OPEX ratio come down as we start to replace what was manual labour with some technology. The technology listens to our, or AI bot, however we'd like to refer to it, will listen to all of the call recordings for training, and particularly to look for cues, so that if a customer is having a phone call and our team member may not pick up that they're in hardship, the AI is listening for those sorts of words. It's also listening for training opportunities to our staff, so that team leaders can say, here's a call that you could have done better. Because when you have tens of thousands of calls happening, the AI it can go and listen to all of them, and it can point out, here are the ones that here's the training opportunities, here's the customers we should call back and offer things to based on cues. Where we'd like to expand that to is customers that are, talking about a new asset that then highlights to marketing teams, say, hey, this person may be thinking of a new caravan because the current one's too small. They may be thinking of upgrading the car because they've just had a child. Or they may be thinking of downsizing, so that we can be always listening with different cues using AI to the hundreds of hours of telephony that get created every day. That's one of the uses that we've seen, and what that's where we started more so than in the credit space.
All right, I'm sure you've been watching the negative commentary, if you want to call it that, around the private credit sector with interest. Do you have any concerns about the potential for, a real tightening of regulations and that actually impacting sort of the broader credit landscape?
Look, our business is somewhat counter-cyclical. We also are a business, compared to many of our peers, that has a lot of equity in the balance sheet. So we have a lot of the funding that we do is funded through equity rather than through third-party debt. So when that tightening happens, it tends to favour our business model, that demand. When a slight tightening in the market can mean that other funders all of a sudden can't fund anymore, and that works reasonably well for us. We see that volume come into us. So it can present some macroeconomic challenges, but in terms of our business, it can also present some great opportunities when the market tightens, because the last couple of years we've seen more availability of cash than we've ever seen, and an explosion in the number of private credit funded lending non-banks in the market. In fact, Australians are very well serviced in that space, unlike 10 years ago. So, some tightness in private credit is likely to be a catalyst for consolidation throughout the industry, in my mind.
All right, biggest opportunity for 2026?
Look, I think the biggest opportunity for us is the challenges we've had with the regulator being behind us, and just being able to get back to what we love doing, and that is providing people access to transport. We are investing, particularly in software, to try and get to consumers and small businesses in an easier manner, and they're actually enjoyable projects for our team to do, and a great place for us to start 2026 as we start to put our challenges with ASIC behind us.
Scott Baldwin there. So, Andrew, it sounds like 2026 will be a happier year for Solvar than this one was. The business sort of seems to have created a bit of a niche out of something which sounds quite simple, but sort of sticking to its knitting and doing something very well in a category where there's still lots of room to grow.
Absolutely. Solvar has done that thing that we all talk about so well, which is find a niche, dominate the niche, and just keep iterating to do it better. I think the reason that it's probably not on people's radars is that it never is a good thing to get in a fight with a regulator, and it's an even worse thing to get in a public multi-year fight with a regulator. So all credit to the Solvar team for getting out the other side of it. From our point of view, that means it's now one that we want to start understanding better. You know, you talked about resilience before, but what better definition of resilience is there than getting through a pretty ugly fight in a very regulated market with a regulator and coming out the other side 50% larger than you were when you went in? So from that point of view, all credit to the team. We would want to watch this space for a bit longer before we rush to invest it. But I think as a potential investment, it makes sense. I mean, it's a very stable business. It's growing nicely. It's got pretty good return on equity and return on capital. And because of its previous challenges, it's available on a PE that is often in single digits, exactly 10 as we're talking today. That's rare. Those are the kind of opportunities that can make you a lot of wealth if you can understand the business really well.
If you haven't sort of heard of Solvar, you've probably heard of Money3, which it used to be, and then it's sort of rebranded partly because of the ASIC stuff, but they wanted to, I guess, do something that they closed their branch networks and wanted to do something that sort of reflected the new business. What would Solvar need to do to become a Teaminvest wealth winner?
More of the same, really.
Of the same.
Keep growing those earnings, keep growing that return on equity and return on capital, and keep paying down that debt that they've used in order to rapidly grow their automotive book. So from that point of view, I think this is a time play for us. It's one where we want to watch this space, see if they keep delivering, and then the power of compounding means that in a few years, if they do, it is likely to tick all our boxes.
Now, if Solvar is a story about resilience in a highly regulated niche, our next company is all about scale, culture, and global opportunity. Merritt Group started with a diesel mechanic in the Kimberley working out of the back of his ute. 20 years later, it's a global leader in heavy equipment maintenance with a market cap approaching $2 billion, operations across Australia and North America, and EBITDA margins that make the big miners sit up and take notice. In this next conversation, Ausbiz's Kylie Merritt sits down with Merritt Group CEO Justin Newick and CFO Paul Hegarty to explore how a people-first culture, internal training pathways, and disciplined financial management are driving 30% compound growth and opening up new verticals and geographies around the world.
A diesel mechanic in the Kimberley started this business, the Merritt Group, out of the back of his ute. And 20 years later, it's a global leader in heavy equipment maintenance with a market cap of nearly $2 billion. I sat down with the CEO, Justin Newick, and the CFO, Paul Hegarty, and asked how they plan to keep up the momentum.
Yeah, I think there's probably a couple of things that, I suppose resonate. The first one is the culture of the business. So from when Luke started the business 20 years ago, it was always about building a business that, us as young technicians would like to work in. So what does that mean? It means you get paid well. It means you get flexibility in rosters, in sites, in equipment. You get to work with your buddies on the equipment that you love. And as we've grown, our customer base has grown, our commodity base has grown, our industry base has grown, and all this just provides more and more opportunities for our people to do different things and cool things. The culture as well is a big thing. We invest heavily in our people. We have a program called 3 Gears that brings people on their time off. They can come together, they can do fun things together. They do camping and fishing and days at Rottnest Island and adventures, which brings people together as a team. It brings people together with leadership and really bonds the teams together. Global Pathways is probably another one as well. We half of our Canadian workforce is Aussies that have had the opportunity to go for a couple of years to a different country, work on the same equipment in a different environment and experience a different part of the world. So for blue collar folk around the world, that is unheard of. No one's moving blue collar people the way we are.
So how do you translate that culture though as you expand into new markets? Because Australians are unique. We can't just pick us up and put us somewhere else necessarily. How have you managed that?
Well, we essentially have done that. Essentially our general management team are largely all homegrown people. Like these people have been off the tools. They've come into the office. They've learned to coordinate. They've become financially literate. They've become business people. We look and seek out the best entrepreneurs on the tools. And these are people that will essentially go and start their own business at some point. We let them run their business within our business. A lot of the senior leaders, our COO is over in the US running our North American operations. The guy that's run the Pilbara for so many years, he's now in Canada running those operations. So again, we've got really committed long-term people that want to see the business grow into these different areas, and they essentially pick up their stuff, move their families, and go and start an exciting opportunity of their own. But that's how we make sure that culture stays strong, and the model stays true to what we need.
That is super interesting. Paul, FY25 highlights record revenue and NPAT, North America returning to growth. Can you sort of give us a little bit of colour on the specific drivers of that performance, particularly in the North American market?
I think a big shift in the North American market was the Canadian business continuing to ramp hard in FY25. That business has impressed us beyond measure as to how successful we've been able to penetrate that market. We are seeing new customer acquisition and internal and global pathways recruitment. So that's our workforce from Australia, plus the internal recruitment from within Canada. Just continue to surpass all our expectations. And that was a key driver behind North America returning to growth. And it doesn't look like it's slowing down, more importantly. FY26 is looking good as well.
Justin, your strategic plan, first billion NPAT target of 65 mil for FY26. What are the, maybe if you could talk a bit about the difference, or is it all organic, or the difference between, organic acquisition? How are you going to sort of achieve those goals?
Yeah, so we're actually 4.5 years into that. So I guess 4 years ago, the board essentially set a blueprint or a roadmap around how we would continue to grow at around that 30% at the compounding annual growth rate each year. And that was essentially laid out to continue to scale the existing business, of course, to grow into different service lines. So that's different trades, electrical trades, welding trades and the like, into different industries. So we've moved into things like rail, infrastructure maintenance, oil and gas, and then also to grow into different geographies as well. So North America, the rest of the world, different states, different regions, even within Australia that we haven't worked as well. So the compounding effect of all of those things in play at the same time has allowed us to continue at those growth rates that have, I guess, not only met but exceeded the target set the targets set by the board to date.
Yeah. So, but different places, different verticals, that's a big, that brings in a whole new level of complexity.
Sure does.
How do you kind of deal with, I guess, execution risk around that? Because it's not, you're not just doing one thing really well anymore. You're trying to do 10 different things really well in all different places around the world.
Yeah, I'd say that's certainly testament to the internal training programs that we have. So, again, we'll bring people in off the tools and over years train them in, in financials, in business management, in the tools and systems that we have. And, the best and brightest get the opportunities to go and do that sort of all over the world. We strategically placed senior leaders around the world to sort of oversee this. But as people from sort of manager and general manager level move into those areas as well, we can keep the model, really, really sound. And I guess probably the other thing is the reporting tools that we have. Like we report things to within an inch of their life. Even to this day, Paul and I will sit down in every manager's P&L meeting every month. We go line by line on the things that are important to the business, and it just helps, just guide those younger managers, make sure that they understand where they're going well, where they're not, and some guidance for the next month. So we can fix problems really quickly before they become large problems.
So, Paul, from the numbers point of view, how do you think about all those different lines in terms of margin and are you guys willing to drop verticals or geographies or whatever if they're not sort of up to the same as all the others?
I think we're always striving for incremental growth at the margin level, but there is some regions and geographies where you're kind of at the maximum that you think you can extract from that particular business line. Anything new, any new vertical, infrastructure maintenance, for example, rail, road transport maintenance, each of those new business models or business areas need to deliver at or equivalent segment margins for that particular region before they can proceed. So when we're looking at a new geography, we're looking at a new industry to move into, if we can't extract gross margin and NPAT margins that are at least equal to our group margins, we generally don't proceed. We're always looking to maintain or incrementally grow our group margin.
So does Australia have the highest margin?
North America has the highest, yeah.
And so I guess the question then is, do you begin to put even more focus on North America if it becomes more profitable?
Fair to say there's a fair fair bit of horsepower over there at the moment. But yeah, again, and I think when you look at the growth as well, I mean, a lot of it is constrained by, senior leadership ready to take that next step, which is why we put such an emphasis and focus on training those people up so that they're ready to go. Could we take on 20 new frontiers today? No. Would we like to? Absolutely. So our internal training systems are so critical in making sure that we're ready for the next growth phase.
From a market perspective, we look at North America, and if you compare it to Australia, we estimate that there is double the number of machinery moving double the number of tons per annum in North America than there is in Australia. So if you look at the Australian business, 80% of our revenue comes from Australia, with a fleet size equivalent to the Australian fleet that moves 3.4 billion tons a year. And you go into North America, it's 7 billion tons of material moved a year. So that means the fleet is approximately at least double what it is in Australia, which means the maintenance requirements are at least double. And then when you extrapolate that out with, EBITDA margins of 20% compared to 12 in Australia, the size of the prize in North America is immense. And that's why we spend a fair bit of our time trying to expand that market.
Is it though, has it got anything to do with Australia sort of being more expensive? Labour, etc.? Is that?
I'd say, yeah, definitely a bit. Certainly the owner miners in Australia, we've been at it for a fair while, and they've got fairly sophisticated procurement teams that that I think have really managed that quite well over the years. So I think that's probably
I think our competitive advantage in North America is definitely enhanced further than what it is in Australia, for sure. Those OEMs in North America have done a formidable job of convincing their client base that they're the only game in town. You have to use an OEM for maintenance. And, when you compare that to Australia, no one is calling the Cat dealer for regular maintenance. But flip that back into North America, what we see there is an opportunity to take more and more market share from the OEMs as our competitive position is sort of understood and more widely known in the market.
Just going back to, you're talking about staff and the importance of training and culture and everything. I want to talk about safety because that's something, critical that you guys mentioned that you've been working on. How do you measure the effectiveness of, I guess, all of those programs that you have in place? And does that build you a moat in terms of, attracting the best people?
Yeah, look, it certainly does. And we, I think if we sort of sat here, we need an hour to go through all of our different safety systems, but it's something that we invest really, really heavily in. Every leader and manager has some, I guess, penalty applied to their ability to earn off the back of keeping their people safe. So we're certainly very invested at one as a business. People are individually or disincentivized around hurting people. Every one of our vehicles that we see, 1,800 service vehicles, all have breathalyzers, all have fatigue monitoring systems. We have a state-of-the-art app that we've developed that has, journey management plans and fatigue plans and, so on and so forth. We've got it, very well, sort of down to a fine art, I guess. How do we measure that? I mean, at the end of the day, I think if we're doing all of that stuff well, our total recordable injury frequency rate will reflect, I suppose, the work we have or haven't put in. And we continue to see that decline, which is a great thing. And again, we're not going to stop until nobody's getting hurt ever. But we're in a high risk industry. We're exposed to a lot of hazards. So to watch that continue to decline, and I'm saying decline is as in injury rates decline. Shows that we're doing the right things. And I think consistency and operational discipline and all of those things on top of the systems that we have are what will continue to drive that. And I think it's fair to say we're industry leading when it comes to those results.
What keeps you awake at night in terms of the cyclical nature, particularly of mining? Does a pullback or fluctuations or volatility in commodity prices have sort of an immediate impact on you, or is because of the nature of what you're doing and also the fact that you're moving into new lines, does that sort of give you protection?
Good. The commodity diversification that the group has definitely provides some reassurance from that perspective around changing market conditions in a particular commodity. about 35 to 40% of our revenue comes from iron ore, 20% comes from gold, 20% comes from coal, and then about 10% comes from the energy markets, oil and gas markets. So we're a fairly diversified revenue base already. When those markets change, what generally happens is there's some short-term pain. Contractors are switched off, and we're included in that. But what tends to happen is that production guidance doesn't change. So the same amount of material is moved, the same machines are still running, with less maintenance being performed on those machines. So very quickly, it moves from a planned maintenance service to an ad hoc maintenance service. And that's where our 1,850 service vehicles around the world come into play. The customers are now buying on an ad hoc basis rather than on a planned basis. And we're able to get there onto site, fix the machine, and tap on, tap off kind of service model. That becomes more and more valuable. So it's a competitive advantage, those service vehicles in a changing market.
Okay. Last question. I know you probably spoke to a couple of investors out there today, and there'll be lots more questions. But what's the investor story? Like, what do people want to know from you? What do you tell them about the future for Mader?
I think everyone just wants to know that the growth can continue is the main thing. And when you look at the addressable markets we're currently in and the ones that we're moving into, I think that is testament to our ability to continue the story going. Our margins have been really, really robust and really stable over so many years. The business model is proven, it's disruptive and it works. And I think our ability, we've already shown that we can go into different geographies and different industries and continue to scale the business. I think if we could do that in a meaningful way with some of these current new markets and emerging markets such as offshore oil and gas, defence, and the like. It's a pretty exciting story to move forward with.
Okay, the guys from Mader Group there. Andrew, this is a real story of scale. We heard how they think they've only scratched the surface, which is what I thought was really interesting, because what they're really good at can be applied not only sort of to new markets, but also to whole new sort of verticals as well. So it's almost like the sky's the limit if they can execute in all those different places.
Absolutely. Mader really have cracked the sauce. There's that lovely joke about Soil and Green, if you remember the movie, of course, that Soil and Green is people. And in the end of the day, all businesses are people too. And what Luke Mader started, and now Justin and Paul have taken on with Mader Group around building that people-first culture to give themselves a real moat, a real competitive edge, is absolutely spectacular. And you see that in the returns the company's generating from a profit perspective, and also that the market is now waking up to that, and the market cap is rising along with the share price. From my perspective, I think what was particularly interesting is that they recognize that because they're people focused, they can take that, as you point out, into other verticals. And so from that point of view, this may have traditionally been a mining services business. But what excites me is that this can be a business across multiple verticals in multiple geographies and get that kind, therefore, of stable growing earnings profile that we at Teaminvest really want from our wealth winners. I think watch this space for Mader. Perhaps I might be mad for saying so, but I think this is one that's going to absolutely shoot the lights out over the next few years.
Yeah, because it's kind of got that people thing is all about entrepreneurialism, really. They're bringing in people with these skills and then kind of saying, well, they would have done this themselves, do it with us. And, the sum of its parts is more than if they'd all done it individually.
Yeah, exactly. And we were all young once. It would be nice if I still was.
You still are, Andrew.
And that idea of being able to, hitch your wagon to an exciting, cool place to work that takes you all around the world in adventure, culture, and in a great workplace environment, working on really cool assets in really cool places, that's got to be exciting to someone in their 20s to 30s. And from the point of view of the company, not only do they then attract them when they're young and get good work out of them in the prime of their life, but that's your pool of management talent to continue to grow the business after. When they say, I've now got kids and I want to settle down in an area, well, who better to run that new location or that new industry than the person who's worked for you for 10 years and been inculcated in your culture? I think it's really smart.
Yeah. So this company listed 6 years ago. Share price is up about 750% since then. How does Teaminvest look at that kind of growth when you run your filters? Because can you keep growing at that pace? It's big.
Look, eventually the compounding means you can't, right? If you keep growing at that pace for the next 30 years, there's no more market. You've owned everything. So I think absolutely we as members will try and adjust that into a more realistic long-term sort of 5, 10, 15-year growth path. Having said that, they have generated a 27% growth since they listed per annum in earnings, and they were pretty confident in announcing at our conference, and I think I've said this in plenty of other market announcements too, of generating double-digit growth every year going forward from here. So that would be a starting point for us in terms of when we're calculating the appropriate price. But the other way to look at it, which is often simpler, is just look at the PE ratio. PEs we know are mean reverting, and they mean revert around the market average. And quite regularly over the last 6 years, Mader has traded at a PE well below market average. They would be times I'd be looking to buy, because then no matter the growth rate, how wrong can you go? And similarly, every now and then it trades at a PE well above market average. And those are the times where I'd be quite happy holding a company like Mader that's growing fast. But you don't need to chase the stock on the way up in the hope of just getting that last little, puff of the cigar. You can wait for the market to be irrational and offer it to you, because pretty much over the course of every year, the market gets irrational at least once on every stock.
We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.